I think this is maybe the biggest hidden gem in the small business world, in the entrepreneur's playbook here. So many people, you start a business because I'm really good at doing X or performing Y type of service. I start out hanging a shingle by myself, then I hire an employee, maybe a family member. I slowly grow, and I just don't know about what the heck are you even talking about a Schedule C in a Form 1120S. These things sound scary to me. Why should I care about this?
The number one reason you want to care about this aspect is that this most likely is going to help save the biggest line item of expense for you as a small business owner, as self-employed, that you're probably not even aware of, which is the worst kind of expense. And what I'm talking about is self-employment taxes. So when you start a business or you have a business, if you're not filing a separate tax return with the IRS on an annual basis, the thing you should know is that you bet your bottom dollar you're a Schedule C filer. How would you know this? Go and look at your individual tax return, and you're going to find a Schedule C right at the top that says sole proprietor. If you're a Schedule C filer, which I just indicated, then you're paying, if you have net income, self-employment taxes, and that rate is 15.3% on whatever your net is. The thing to note is that you don't have any say beyond the expenses of your business on how much that tax is going to be, meaning it's just a flat rate. If you want to know how much you paid last year or any year in the past, look a little further in your individual tax return, and you're going to find a Schedule SE. S is in self-employed, SE. And you will see at the bottom of that page how much you paid in self-employment taxes. Now, with this, Mike, when we talk about self-employment taxes, you know as well as I do, but for the viewers, what does that really represent when we're talking about your company, when we talk about what those taxes are?
In JJ, this is incremental additional to personal income tax.
Yes.
Yeah.
Yes. Yeah. So this is in addition to the individual tax, but with you guys doing payroll, you know that when you are an employee, so for most that are starting their own business or they're self-employed, you probably at once upon a time were an employee. And when you got paid, there was Social Security and Medicare withheld, FICA, and it's 7.65%. And then that company, whether you were aware of it or not, also matched that percentage, which is 7.65%. Let's add these together. That's 15.3%. This is the magic that I want you to hear on why you don't want to file a Schedule C and why you want to file a Form 1120S, is because the net income, when reported on a Form 1120S, is not, by law, subject to this 15.3%. So if you want to know, well, what am I going to save by filing an 1120S versus filing a Schedule C? I'm trying not to throw a lot of schedules, but in terms of the viewer literally able to know right now how much they're able to save, go to the Schedule SE in your individual tax return, and you will see right there how much your self-employment taxes are, which is also on Schedule 1 that flows right to your Form 1040. And Mike, as you just indicated, that's in addition to your individual income taxes. So I'm going to just pause there for a second to say your individual taxes, let's just say for grins, is a blended rate of 25%, right? That's a successful small business.
Sure.
Your self-employment tax rate is 15.3%. And then if you're in a state, what is that state tax rate? And what I'm telling you is all of a sudden you add these numbers up and 45% of your net income is going to taxes with that number one line item that I just told you about that's just hiding in the tall grass like a snake called self-employment taxes.
JJ, we think about our number one expenses being real estate and people, but the biggest expense we probably have the most control but the least knowledge about is taxes.
Yeah, absolutely. I mean, you take someone that's filing a Schedule C, and I bet on average, that they're probably grossing about 200,000 or less, if not 100,000 or less. And most Schedule C filers, they're scrambling for all the expenses that they can get their hands on. But most Schedule C filers probably are not going to have more than about 50% in any expenses. So just to do some simple math, if you have a Schedule C filer, they gross 100 grand, they have 50,000 in expenses, so they net 50 grand. They're going to pay 15.3% on that 50 grand before they even pay their income taxes. That's going to be about $7,500. And I bet when you would look at that self-employed's expenses for their business, I bet there is not any other expense that is much more than the $7,500. Now let's talk about this 1120S. So where I get, and you kind of nailed it, it's like, oh gosh, this sounds a little overwhelming, a little scary. The thing to note is that if you would just go to irs.gov and look up Form 1120S and click on the form, because page 1 of that form, you're going to see looks pretty darn similar to a Schedule C, believe it or not, because all it is this, reporting your income and your expenses. So here's what I want you to take away from this, is if you do not file a Schedule C, but we use these same numbers, you gross 100 grand and you have 50,000 in expenses, so your net income is $50,000. Well, guess what? That gets reported on your individual tax return, because the great thing is an S Corp has no corporate level of tax. But you're literally, in this 1 year, in this one example, going to save $7,500, because by law, the net income, if you just report it through an 1120S, is not subject to the self-employment tax. So very briefly, you do need to formalize your business at the Secretary of State. 10 out of 10 times, it's pretty much going to need to be an LLC, get an EIN, and then you need to set up a separate bank account. If you think that's too much of a hassle, what I want you to remember is, in this simple example, it saves $7,500. Mike, you had said before, when we were kind of visiting before we got started, about the number of new businesses and sole proprietors kind of going out and getting an EIN, kind of leading in and out of the pandemic.
Yeah, it's a total hockey stick as people got laid off. But even when people didn't get laid off, as we know that the jobs have largely come back. We're not totally where we were pre-pandemic, but the participation rates is way down, because people are choosing alternative paths, right? They're choosing gig economy options. They're maybe starting their own business from their house. So the number of EIN registrations, the entities have exploded. And presumably these are all, either zero employee or one employee firms to start up.
Yeah. And the thing is that I'm also experiencing this, that there's lots of people that are still employees, but they're now, to use that term you just did, the gig economy, the gig businesses, but they have found something to do in addition to that, to add to their financial security. But here's the reason that they really need to look at the 1120S carefully, okay? Because you would probably have most people say, all right, well, what's the catch here, JJ? The catch is that when you are an S corporation, that's a business that elects with the IRS on a Form 2553, which is pretty straightforward, you then now are now in a position that you have a separate entity, a separate, in essence, identity, which is then in existence by a separate EIN number that we were just talking about. But when that happens, you then need to pay yourself some payroll. And this is where you then want to hear a few more numbers from me, which is this. If you have somebody that has an S Corp, the IRS, in essence, is aware very keenly that that net income is not subject to self-employment tax. But the reason it's not subject to that tax by statute, meaning by law, is that now for that owner, they have two ways to get money out of that business. One is called a distribution, which is not taxed again. It's just simply a check. It's very much like a dividend, but the difference between a distribution and a dividend is that a dividend is taxed again down at the individual level, where a distribution is not. But here's what I want you to hear. You do need to pay yourself payroll. And this is where many fellow tax pros, EAs, and CPAs kind of fall asleep at the wheel. And I don't want to use this word too heavily, but they're lazy. And what I mean by that is that many tax pros will say, well, if you're an S Corp, now you have to do payroll. Now you're ready to hear, well, what's the catch? Here's the catch. When you pay yourself payroll, as I was telling you earlier, even though you're the owner of the business, you're now an employee just the same as any other employee, which means that back when you were an employee for somebody else, or when you're paying anybody, there's going to be that 7.65% of Social Security and Medicare, it's FICA, withheld, and then now this company that you own is going to match that. Guess what? What I had told you earlier, it's 15.3%. But here is then where the magic happens is, and I'm not talking about now we're in essence taking advantage of the law in a way that's going to get you in trouble, but where the advantage comes with an S Corp is that you get to choose what your salary is. Now we could basically go in a direction and say, well, I'm going to pay myself 12 grand a year. The IRS does want you to pay something reasonable, but in that example I just told you, if somebody grossed 100 grand, they had 50,000 in expenses, I'd probably be counseling that client to probably pay themselves about 20,000 a year in a salary. That then means this, that 20,000 was subject to the 15.3%, but 30 grand was not subject to it, which that person then saved $4,500. But see, this is why they need to get with a company like yours, the affiliate, because when you now have payroll, this is where then the tax pros get lazy. And what I love about what you told me about your company and your mission is that you're building and fostering relationships with tax professionals like myself, CPAs and EAs.
Right.
To then say, hey, listen, when you have a client that now is going to be an S Corp, you don't need to worry about doing all the filings that go along with it. And this is where then many people kind of draw the line and go, well, I don't want to do all this extra filing. And that's where you all come in. And this is why I don't do payroll for one client. And I've had my own practice now 25 years. So for the last 20 years, I won't even bring on a client if they won't use a third party. And the reason I say that is that we know that when we're dealing with payroll, we've got reports that have to be filed with the IRS and with the state. There's different due dates, and some are quarterly, and you're withholding taxes and you have to get it paid in. But all of that, when handed over to a professional, to a group like you guys, that it's number one, what you do every day. It's what you eat and breathe. You are the experts on this. The other thing is that any questions that come up and entanglements, you're going to be able to take care of it. And here's why I just go back, and I'm not trying to stick anything to my fellow tax pros and EAs, but see, I've traveled around the country talking to fellow CPAs and EAs, over 50 cities. And one of the things I always ask is, hey, at what point should somebody be filing an 1120S and not a Schedule C? And in my opinion, it's around 20,000. So if you're netting more than 20,000 and you're not filing 1120S, I really think you should take a hammer to your hand, because that's really what you're doing to yourself. But most CPAs said it was about 100,000, which means that they are in a position where they are influencing their client to just do the easy route, which is to continue to file the Schedule C. So to save taxes and to do all this, you have to walk and talk just like any other business. But isn't that worth it? In that simple example I just told you, over a 10-year period, you saved $45,000. And that's assuming that you never made more than 100 grand gross.